Hey Buy Nation, Joseph Hogg here with your weekly market update. Every Monday morning at 9 a.m., we bring you the stocks to watch and the stock market news you need to see. Let's dive in. Great news on inflation led to a market crash on Thursday, but if we look deeper, 3 out of 4 stocks in the S&P 500 actually closed in the green for the week. Thursday's disruption was historic. Only one other day since 1979 saw a bigger difference between small and large stocks. This could signal a major rotation in the stock market. Are you ready? Today, I'll detail what is already becoming the great rotation of 2024 and the 7 stocks you should buy before it's too late. I'll also give you updates on Tesla and MicroStrategy, but first let's talk real estate. Now you know I love real estate. It's a tangible asset that can provide both income and appreciation. And right now, real estate stocks are looking like a screaming buy. Why? Because they're direct beneficiaries of lower interest rates. The highest rates since 2007 have crushed cash flow and values for commercial property. Real estate stocks are down 2% this year after a disastrous 2022. If rates come down, money will flood back into real estate, pushing prices higher. So what should you be looking at? Lodging and resorts are looking particularly attractive, as are telecom REITs with their stable cash flows. These companies will benefit from a resurgence in travel and demand for data centers. And keep an eye on the real estate sector ETF, XLRE. It jumped 5% last week, showing that investors are starting to smell the profits. Within the REIT space, 2 companies stand out to me: Host Hotels and Resorts and Crown Castle Tower. Let's start with Host Hotels and Resorts. This company is a lodging REIT with a portfolio of luxury and upper upscale hotels in major cities and resort destinations. And get this, they're currently offering a 4.5% dividend yield. That's right, you can get paid to wait for the real estate market to rebound. Now let's talk about Crown Castle Tower. This company owns and leases cell towers, small cells, and fiber optic solutions to wireless carriers. They've sold off a bit recently, but their long-term growth story remains intact, especially with the rollout of 5G. And don't sleep on data center REITs like Digital Realty. These companies own and operate the physical infrastructure that powers the internet, and with the explosion of data, their future looks bright. Plus, they tend to offer solid dividends, which is always a plus in my book. Now, real estate isn't the only sector that stands to benefit from lower interest rates. Regional banks are also in a prime position to outperform. Think about it. Lower rates increase the value of their bond portfolios. Plus, it improves the outlook for commercial real estate loans, a key source of revenue for these banks. No wonder the SPDR S&P Regional Banking ETF was up a whopping 8.5% last week. But that's not all. Lower rates are also good news for growth stocks. Why? Because they increase the present value of future cash flows. And when it comes to growth stocks, it's all about the future. So, which growth stocks am I watching? Well, I'm keeping a close eye on companies like SoFi Technologies, UiPath, Shopify, and Unity Software. These are all innovative companies with disruptive business models that are well positioned to benefit from a falling interest rate environment. Chapter 4. Don't forget small cap stocks. Now, if you're looking for even more upside potential, you need to be paying attention to small cap stocks. These are companies with market caps between $2 billion and $10 billion, and they're often overlooked by institutional investors. But here's the thing, small cap stocks tend to be more sensitive to interest rates than their larger counterparts. So as rates fall, their financial outlook improves dramatically, leading to potentially outsized returns. And the good news is that small cap stocks are already starting to heat up. The iShares Russell 2000 ETF, which tracks the performance of the Russell 2000 index, rose 5.5% last week. That's a clear sign that investors are starting to rotate into this segment of the market. Now I know what you're thinking, small cap stocks are risky. And you're right, they can be. But they also offer a lot of growth potential. And if you're looking for a way to diversify your portfolio and potentially boost your returns, small cap stocks are definitely worth considering. Chapter 5. The Power of Equal Weighting. Now, if you're looking for a more diversified approach to the stock market, I've got another ETF for you to consider, the S&P 500 Equal Weight ETF, RSP. What makes this ETF unique is that it holds all 500 stocks in the S&P 500 index in equal amounts. That means you're not overly exposed to just a handful of mega-cap tech stocks like Apple, Microsoft, and Amazon. Instead, you're getting broad exposure across all sectors of the market, from healthcare to financials to energy. And because the ETF is rebalanced quarterly, you're always buying low and selling high. Now, the RSP isn't going to be the sexiest investment in your portfolio, but it's a solid core holding that can help you achieve your long-term financial goals. And in a market that's becoming increasingly volatile, that's more important than ever. Chapter 6. Tesla, SoundHound, and MicroStrategy updates and analysis. Let's look at some stocks making headlines. First, Tesla, TSLA. Their 11-day winning streak ended due to a robo-taxi delay, but Tesla remains a long-term buy. Next, SoundHound AI and Sound shares soared 46% after a major partnership. Finally, MicroStrategy, MSTR. They announced a 10-for-1 stock split, making shares more accessible. Chapter 7. Watch out for consumer weakness. Now, before we wrap things up, I want to talk about one potential headwind that investors need to be aware of: consumer weakness. Consumer spending accounts for over 70% of the US economy, so any slowdown in this area could have a significant impact on the stock market. And there are some signs that consumers are starting to pull back. PepsiCo, for example, recently reported disappointing earnings, citing lower consumer spending as one of the main culprits. And Conagra Brands, the maker of Slim Jims and Bird's Eye frozen vegetables, also issued a disappointing forecast, blaming inflation and rising interest rates for squeezing consumer budgets. Now, I'm not saying that a recession is inevitable, but it's something that investors need to be prepared for. And one way to do that is to make sure your portfolio is diversified across different sectors and asset classes. Check out the Arrived Homes platform to invest in real estate with the link in the description. Join the waitlist to stay updated on new opportunities. Click on the video to the right to see the 5 stocks NVIDIA is buying for the next wave in AI. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification. Thanks for watching and see you next Monday. And that's it for this week's market update. Remember, the great rotation is just beginning. Stay informed and stay invested.